PepsiCo is shaking up its beverage portfolio. The company said today it will sell Tropicana, Naked, and other select juice brands to private equity firm PAI Partners. The transaction will net PepsiCo pre-tax cash proceeds of about $3.3 billion. It will also retain a 39% stake in the new joint venture. Joining us now for more is PepsiCo Vice Chairman and CFO Hugh Johnston. Hugh, what are you doing here? It's not earnings.
Good morning, Brian and Myles. How are you? Great to be with you.
We're hanging tough. Good to see you again here. So take us through this. Why do you decide to make this transaction?
Sure. As PepsiCo, we're pretty focused on capital allocation and ensuring that we're always optimizing our portfolio to get the best results. And as we went through an exercise on that over the past 18 months or so, we came to the conclusion that given our orientation towards higher growth and improving our margins, Tropicana was probably less of a fit with the portfolio than it was before. So we made a decision that it probably made sense to move Tropicana elsewhere. At the same time, we thought there was some untapped potential in the business, and PAI as a private equity firm has got a great history of extracting value out of good assets like they did with Nestle with their Ferneri transaction and Yoplait. So we put together a deal where we're going to participate in the upside going forward, but at the same time, we're going to focus the capital as well as our efforts against the categories that are higher growing. Oftentimes, that's going to be things like healthier snacks or zero-calorie beverages, or of course, our great SodaStream business.
Does this transaction help lift the profit margins in your North America beverage business? Does it take it to double digits now?
It'll take it up. It doesn't quite get it to double digits, but it clearly is a move in the right direction in that regard. Now, that said, for the first half of this year, beverage margins have been double digits anyway. So we're feeling good about the progress on that. Our goal is obviously to get somewhere up around the mid-teens over the course of the next couple of years. And we've got a significant plan in place that Kirk Tanner, who runs the business, and myself, and obviously our CEO are highly focused on executing against.
Now, Hugh, you guys talked in the most recent quarter, as you have for some time, about that $1 billion in savings through 2026 plan. And I'm curious how we're supposed to think about this in the context of that initiative, or is this maybe something different with respect to reshaping the portfolio?
Sure. No, those are completely separate. The $1 billion is the business that PepsiCo will be running going forward. So that number absolutely still remains the same. This is really just a portfolio optimization decision that we think makes sense, because if you look at what we've done recently in terms of M&A type activity, it's been mostly geared toward higher margin, higher growth businesses. Rockstar obviously is a higher margin business. The SodaStream deal was higher margin and higher growth. Pioneer is a great long-term growth play. So we've been steering the portfolio in that direction. That said, with the proceeds of this transaction, we expect to use these proceeds to strengthen the balance sheet and to organically invest back in the business.
Hugh, when you say strengthen the balance sheet, is this are you looking at a special dividend or raising your stock buyback plan, or this is almost all going to flow through to the bottom line?
No, it's really going to be geared. The portion that strengthened the balance sheet is about debt reduction, because obviously when you're losing EBITDA, you're going to take debt down as well in parallel with that. So that was what that reference was about.
Hugh, for as long as I've covered PepsiCo, I've only known the company to be an acquirer. Do you have other brands that you're looking at within the portfolio that may not fit any longer?
Nothing to share today. What I would tell you, though, is we're always looking to optimize the portfolio. And you're right, Brian. Generally speaking, we have been an acquirer, but we've also refranchised bottling businesses over time in international as well. So we're constantly looking at how do we make this portfolio even better and even stronger so that we can grow it faster.
Now, lastly, real quick, Hugh, does PepsiCo deserve a higher multiple on its business today as compared to yesterday after this deal?
Well, I think the market will decide that for us. But, my point of view is the multiple should always be higher.
Fair enough. Well, we'll be asking you about that multiple come earnings season, which is probably in a couple weeks. PepsiCo CFO and Vice Chairman Hugh Johnston, always good to see you.
Thanks. Great to be with you guys.
All right, but first, we're going to stick on earnings here. Under Armour shares are on the move after the company beat analyst earnings forecasts and issued upbeat full-year guidance. Simeon Siegel is a managing director and senior retail analyst at BMO Capital Markets and joins us now. Simeon, always good to speak with you here. Some pretty eye-opening growth rates for Under Armour. What are you expecting over the next few quarters? Because clearly Under Armour is not going to continue to put up triple-digit growth rates.
Guys, it's great to see you in the studio. Can't wait to be
We're
there
back,
in person
baby.
again.
We'll see you soon.
Love it. So to the point of being back, listen, Under Armour, you and I have been talking about this one for a while. I think they're one of the best examples of a company that said the pandemic is happening. Let's take advantage. And you watch this repurposing of the business. You watch this elevation of the brand, even at the expense of sales. So I think that's what we're seeing. I think you saw a broad-based beat. I think we'll continue to see right now, even this new guidance being conservative. But I think what we're going to see is a management that's very committed to raising profitable sales, as opposed to perhaps an Under Armour of the past that was focused on growing sales regardless of the cost.
Well, Simeon, there's some interesting financial stuff that we can get into here with the quarter, but let's maybe just start with sort of the merchandising side of it, the retailing side of it. What is Under Armour selling now versus what they were selling, and what areas of their lineup, I guess we could say, do you think they're going to continue to invest in, and are there others they'll move away from?
Hey, Myles, yeah, it's a great question. Listen, the first descriptor is they're selling less. And I think it's odd to be applauding that, but it's important. So in terms of their lineup, they're selling fewer units. One thing that they got to on the call was that they're expecting the North America revenues this year to almost get close to the FY19 levels. That's really important because they've pulled back from discounting, they've pulled back from off price, and they've done more direct. That means the same revenue level is on a lower unit basis. So they're selling their footwear, they're selling their apparel, they're selling less masks, but they're still selling accessories. At the end of the day, every one of those units that sells is selling at a higher price. And I think that's the point. I think it's finding those brand loyalists that want the Under Armour logo because they believe what it represents. They're going to be willing to pay more. It's the people that walked into the door simply for a discount that'll walk out when the discount evaporates. Those are the units that they've walked away from. And I think that's a healthy part of the business.
Simeon, in terms of wholesalers, VF Corp last week, good quarter. Vans business maybe a little squishy here. Levi's, good quarter. Under Armour out this morning, good quarter. Profit margins, meh. Columbia Sportswear, good quarter. Which wholesale stock in terms of retail, which one is the best to own and why?
Listen, this one's looking interesting. You also, Ralph Lauren reported today, another strong AUR lift. We are in this scenario. We've talked about this before on the program. You've got tremendous capacity to spend because of stimulus. You've got tremendous desire to spend because of pent-up demand. And you've got nothing to spend on because of supply chain bottlenecks, so prices are through the roofs. There's a scarcity value. You're now taking that. That's existed for 1Q, 2Q. You're now taking that into back to school period where we didn't have a school last year. So compound those three things with the fact that this should be the best back to school we've ever seen in our lifetime. And the reality is you have this meaningful wholesale and direct revenue opportunity that I think the street understands. I don't think that anything I just said should sound all that insightful or all that surprising. So what's interesting is you talk about those numbers and then you look at the stocks, and the stocks are moving today, but they're not exploding upwards. So I think that there's an element there where we do need to acknowledge that this conversation, the best retail environment that we've seen in a very long time, if ever, is not a surprise retail environment. The question is, what do we look like next year? And so that's where I think, and I know I keep coming back to this unit versus price point. That's where I think it's going to be important to understand who pulled back promotions and raised price proactively because they see value in that versus who's capitalizing, who's benefiting from the sheer rising tide lifts all boats. If there's no product, you have to raise price. Because when we get into holiday, when we get into next year, that's where we find out who's going to chase that promotion, because promos will come back. They won't come back for everyone, but they will come back. So that's why as I look at these, I think we should expect strong performance out of most. And Brian, to your point, gross margin will be the metric to watch. I believe revenues are a measure of brand buy-in by customers. Gross margin is a measure of brand perception. So we'll be able to see that. But right now, expect anyone who has product on the shelves will sell it, and they'll sell it at a higher price.
Well, let's talk about the product on the shelves, Simeon. There's been some extreme weather in China, key manufacturing regions, and there is some concern building. Will retailers be able to get the product they need for back to school in the holiday? Is that a major risk as you see it?
Yeah, and also we have obviously COVID cases, unfortunately, that are outbreaking in terms of factories. So it's not just it's weather, it's also health. So last year was the year of light revenues, high margins. Holiday 2020 was probably the least chaotic holiday we've seen in a very long time because, to your point, there was no product. That is continuing to different manifestations. But I think that right now retailers are operating it's not new, right? The notion that supply chain hasn't gotten better is true. But the notion that all of a sudden inventory has stopped isn't. I mean, think about the last time we were talking about the Ever Given. So I think what we'll find is increasingly that supply chain does open up, and increasingly stuff that's been on the water starts to trickle back in through the ports, and there's openings. But no, I think everyone has to be ready for this notion that there still is going to be scarcity, and therefore, if there is scarcity, you want to maximize the dollars of every unit you have. Ultimately, that seems a little bit more transient. Ultimately, that seems less structural. And ultimately, I think we do get more product. And that's when we're going to find out whose brand elevation actually repurposed the way customers see the brand. And therefore, their appetite, their price elasticity of demand has been structurally reduced. Who's willing to pay more versus who's going to go right back to that 30 off promotion. And I think we're going to find that's where we start seeing the winners and losers emerge.
So let's also maybe talk more about the specific, one specific segment of this kind of retail revolution that Under Armour is at the center of, which is athletic wear and the way that that is used across our lives. Also in the context of a pandemic where people were exercising maybe more at home, depending on who you're talking to. And so I'm thinking about Under Armour versus the Lulus, versus the Nikes, in the context of a very strong Peloton market. How does it fit into that conversation? Because that's the brand's DNA. Right? It is for competition wear. They've changed that a little bit, but that is ultimately, it's a sportswear brand. Sports at the emphasis of that.
And so listen, I know you guys are in studio, but like if we made Sozzi stand up, is he still wearing shorts underneath the suit?
He's wearing,
I've got the whole suit. I've got the whole suit,
like
the whole thing here. The whole thing.
Total clown over here.
Well, I'm still at home, so I won't stand up. But I think Myles, the point you bring up is fascinating, also in light of the fact that Ralph Lauren just reported today, because how much changed, right? How much is it Nike versus Under Armour versus Lulu versus Adi versus is it also that collective versus Ralph and PVH and VF and everyone else that sells clothing at this point? So as we talk about the go back to work mentality, not everyone is going to be as finely or as sharply dressed as the two of you. I think a lot of people will internalize that comfort's here to stay. So that's going to be this really interesting dynamic where we've bucketed these groups and perhaps they're not going to be as siloed anymore. Perhaps athletic wear is going to become even more acceptable than it otherwise was, and it was moving in that direction anyway. So I think that's going to be a really interesting trend to watch. Is it still the same pie, or did the pie expand within what is okay for athletic wear? What we're seeing obviously right now, whether it's Nike essentially giving us an analyst day reset with much higher numbers on their last earnings call, or whether it's Under Armour showing us this ongoing progression, athletic is working. And I think that will continue to work. Comfort is working, that'll continue to work. So whether it's this notion of, I need to decide between an Under Armour or a Lulu, or whether it's this notion of, okay, what gets me through that getting back to work mentality, I tend to be in that latter camp. And I think the question is going to be, what's the impact on the traditional wear to work companies a little bit more than what's the impact on fighting the athletic companies fighting against themselves.
Simeon, you have been our go-to guy on all things limited brands and Victoria's Secrets. Today, Victoria's Secret officially splits away from limited brands on the Yahoo Finance platform, ticker symbol VSCO. Are you a buyer here?
Today's the day. Listen, I've historically been saying that Victoria's Secret was this fascinating, underappreciated opportunity. I'm in print saying there's earnings upside to that Victoria's Secret opportunity. I think everything we've talked about and everything we talked about on the show today, again, kind of aligns with those published views. And I think the reality is there's going to be very interesting. That story, if Under Armour was a prime company that took the opportunity, raised price, recognizing you can sell less and charge more, there's no one who did that stronger than Victoria's Secret this past year. So I think keep watching that. I think this notion of understanding who you are and how big you're supposed to be versus how profitable you can be was a very, very strong shifting point last year that Victoria's Secret was a very strong architect for.
Do you think they can successfully pull off being a more inclusive brand along the lines of Aerie?
Yeah, listen, it's a great question. And they've been very explicit about their focus, that they watched the world passed them by, and now they're going to make up for that, and they're going to fix that. So I think there's going to be a key focus on the marketing. The team on the analyst day said as much, again, very explicitly. So I think keep an eye. I mean, watch that. The marketing has definitely changed, and it will be something we'll continue to monitor.
Fair enough. Simeon Siegel, always great to see you. Stay safe. Maybe we'll see you in the studio sometime in a suit.
Looking forward to it. See you guys.
All right, we're now 11 days into the competition at the Tokyo 2020 Olympics. Plenty of headlines about the ups and downs of the games, and of course, plenty of controversy, but of course, plenty of successes and a lot to celebrate for American athletes. And joining us now to discuss his recent gold medal victory, 4-time Olympic gold medal winner, Ryan Murphy. Ryan, appreciate the time this morning. Congratulations on everything that happened for you guys over in Tokyo. I'd just like to get your thoughts on your impression of this games, versus your experience in Rio, and sort of how you as an athlete, navigated those two events.
Yeah, I think Tokyo did a fantastic job in terms of navigating the challenges of COVID and the challenges of hosting Olympics. I think it's been a beautiful game so far. I can't wait to watch the rest of it. In terms of the differences between Rio and Tokyo, I'm someone where when I'm at an Olympics, it's kind of a business trip. I'm going to my room to the pool and back anyway. So this year was not super different in that case for me. In Rio, there were definitely more opportunities for distractions. If someone wanted to do that, this time everyone had to treat it like a business trip.
And I'm curious, Ryan, when you got to the pool and you are over waiting for that buzzer to go off in a final, does it feel the same, even though there are only basically your teammates and some coaches in the stands versus what you've seen at a Worlds or what you've seen at Rio? And does your mind kind of get to the same place knowing it's an Olympic final, regardless of how many people are there in the building?
Yeah, I think to be fair, I definitely did miss the fans. I love having the crowd in the stands. They do add a level of excitement, a level of adrenaline. Team USA did bring the energy, though. Our team was definitely well represented in the stands. We were definitely the loudest group. So it was fun. It did feel pretty intimate with that group. Right when you finished, you were able to quickly spot your friends and teammates in the stands and give them a little flex or a point, and that was something that is really special. As compared to Rio, we had no idea where our team was sitting as we were competing, and so it was nice to be able to see them real quickly after each race. And
Ryan, I know you've gotten this question, but we have not had a Tokyo athlete on our program yet, so I must ask about the beds.
The beds were hard. I brought a mattress topper because I kind of anticipated that at an Olympics, I think the thing that was nice is knowing that the beds were not going to be great. They weren't great in Rio either. The pillows are never great. So I packed a pillow, I packed a mattress topper, and it definitely helped my sleep quality out there.
Ryan, we have heard that you enjoy stocks, you enjoy the markets. It's something you have followed for some time. What are some of your biggest things you're looking now at the markets as you perhaps have just a little bit more time on your hands?
Yeah, well, I got to get caught up. The past month and a half, I've really been dialed in on the swimming and have not paid too much attention to the stocks the past month and a half. So I got to get caught up on everything that's been going on. And I'm really looking forward to that, to see if everything I'm holding still makes sense. If I've got to shift into something new, I do really enjoy following it.
Well, and that does bring me to a question, Ryan, that I always think about when I'm watching you guys compete. It's a 4-year build-up to this moment, and then there's this huge come down of like reintegrating in some ways to civilian life, let's call it. I mean, what is this is this a couple months for you to sort of take a step back from training and calm down again? Like, how are you going to plot through the next few months after having been not just focused on Tokyo for 4 years, but actually 5, given the COVID delays from last year?
Yeah, and that's a great point. Everything is really geared towards the Olympics and my sport. That's where the major goals are. We're always operating. We call it in the quad. So that's a 4-year plan. We're always looking towards the end of that and trying to create checkpoints along the way so that we stay engaged over that entire time. I think outside of the pool, I do have a lot of interest. I am really looking forward to getting involved with some philanthropic efforts with some of my partners. Bridgestone is doing a really cool campaign to help young adaptive athletes chase their dreams. They've made a huge donation to the Challenge Athletes Foundation, and I'm really looking forward to doing great things with my other team, Bridgestone athletes, to help those kids chase their dreams.
Ryan, you're working with Bridgestone, but how do you also pick potential opportunities and people you work with? I imagine you're coming back and you're getting inundated with people that want to work with you.
Yeah, I think the biggest thing is you have to be authentic to yourself. You have to be comfortable speaking about the things that you are endorsing, and people can tell when you're not being real. And so for me, I really try to look for companies that are top in class, and that are really interested in both their business and also their philanthropic efforts. So those are the two main things I look for. I want to be with companies that value me as a person and an athlete. So those are probably the main things that I am looking for.
Ryan, before I let you go, our colleagues at Yahoo Sports, they were on the ground at the Olympics. I know they covered your swimming and your events very, very closely. Can you just clarify what you meant with regards to the Russian swimming team? Anything you want your fans to know?
Yeah, 100%. I think context is really important. After the race, I was asked a really specific question about doping in swimming, and I answered that question honestly. I do think there's doping in swimming. It's something that I've talked at length about with the CEO of USADA, so that's U.S. Anti-Doping, Travis Tiger. He's someone that follows, that spends every day talking about doping, researching doping internationally. He's made some dire statements in this past year, and so I think as a result of that, I do think there's doping in swimming. I didn't specifically name any country. I didn't name a specific swimmer. It's disappointing to me that it was taken in that way. And so I have connected with Evgeny Radov offline. We've had some good conversations. And I am really looking forward to seeing how the sport improves. I think there's definitely room to grow, and I look forward to being a part of that.
One more games for you, or only 3 away? Only 3 years away for Paris?
Can't wait. Yeah, I'm really looking forward to these next couple of years. I love this sport. I'm really motivated, and hopefully Team USA is going to be great out there.
All right. Ryan Murphy, gold medalist in Tokyo, 4-time Olympic gold medalist. Ryan, appreciate the time this morning. Congratulations.
Thank you.
As we await Lyft and Uber earnings, there's a new competitor in New York City that's all electric and, unlike the gig model, treats its drivers as full-time employees. That's right, a fleet made up only of Teslas and drivers with guaranteed wages and healthcare benefits. And for more on the break from that norm, happy to bring that company back on. Revel's co-founder, Paul Suhey, joins us now. And Paul, I mean, you started out, I knew Revel with the moped kind of side of the business, scooters around the city. Now a very different direction here with 50 Tesla Model Ys, essentially licensed as company-owned taxis now, serving everybody out there. So why is this model going to be better for not just New York City and the riders, but the drivers as well?
Yeah, thanks for having me on, guys. I think just to start, and maybe you had this question of why go into this? Why are we going into electric rideshare? And really our goal and everything that we try to do as a company is to lead cities into a zero carbon future. That's what we're thinking about. And we think that the most impactful, important thing that we can do right now is integrate an electric rideshare service with the build out of charging infrastructure. We think that will really bring demand that is needed for a massive build out of infrastructure that's just going to drive the electrification of a city like New York that we need today and we don't need in 2030 or 2040.
It's been interesting to see the pivot here from, as Zack said, from a moped company to a larger infrastructure play. At least that's what it looks like. You started by establishing the charging stations first. Now you've got, as I understand, about 150 drivers out there here in New York City. How do you plan to scale the operation?
Yeah, so we're going to take it one step at a time. I think that's one thing that we've always done as a company. We've always started small, learned from initial operations, proven demand, and then grown responsibly. If you look at the history of the company with our moped business, we did the exact same thing. We always said that our goal was to serve the entire city, serve all of New York with that service, but we started small. We started in Brooklyn, but we eventually expanded over the years into more of Brooklyn, into Queens, into Manhattan, and the Bronx, doing the same thing here, starting with an initial fleet, starting small, proving demand. But we really, our goal as we're launching this service is how can we serve more of New York? How can we build this service out? But we really just need to take it one step at a time.
Yeah, sure. There's going to be bumps along the way too. I mean, as you roll this out, when you think about demand, though, obviously people know Lyft, people know Uber quite a bit. But when you think about your guys' demand and what you're expecting or hoping to see, maybe 6 months, a year down the line, I mean, talk to me about how you expect to meet that demand and what the wait list looks like now.
Yeah, so we're seeing crazy demand. Even with a fleet of 50 cars, we already have over 50,000 people on a wait list waiting to try the service. And I think a big reason for that, people are just excited to get in a Tesla. And you have to realize that for the vast majority of people that are trying Revel Rideshare for the first time, it's not only the first time they're getting a Tesla, it's the first time that they're getting in an electric vehicle in general. So just the exposure that we're giving people to EVs is great. And I also think people are just excited for a new experience. The wow factor that really the rideshare came to market with about 10 years ago of being able to call a ride on your phone for the first time has just deteriorated over time. And now we're bringing that wow factor back with a fleet of baby blue Teslas, with a passenger seat removed, with a professional driver, giving riders the potential and ability to control their ride, to control music, to control temperature. And I think we have just a lot of people that are excited to give it a try.
Yeah, Paul, I should point out I saw 3 Revels already yesterday, just within 1 block of my place here, just near East Village. So you've already got a lot of riders, at least in my neighborhood. But I want to get back to what you said earlier about what the underlying driver here is for the company, which you say is to sort of move towards this goal of a lower carbon future. Is the idea by launching this service to try and make a dent and eat into the market share of Uber and Lyft? Or is it about that experience that you pointed to, hoping to try and convert potential drivers who may not necessarily be customers, but through the experience in Revel into EVs?
Yeah, the goal 100% is electrification. That's what we're focused on. So to do that, we are the first integrated mobility company. And the reason why we're doing that is the major challenge that we see in cities, if cities are going to electrify on any reasonable time frame, is infrastructure. The problem is it simply just does not exist. It doesn't exist. And what we're doing by integrating, we're bringing captive demand, we're bringing demand to the build out to power a quicker build out of charging infrastructure. And we're doing that not only to serve our own fleet, but we're making that infrastructure that we're building completely publicly accessible. And we hope in doing that, it helps to not only electrify our rideshare service, but other rideshare services, the taxi fleet, the general public of consumers that are using EVs. That is what we're after, and that's why we're going this direction.
Yeah, it's a kind of interesting full circle moment, I suppose, right? When we think about how New York had taxis, and then you had Uber and Lyft come in, you had a bunch of taxi drivers not so pleased about it. Then you had workers who were gig workers, not so pleased they didn't have benefits. Now you guys come around and basically create this kind of opportunity. So, I mean, talk to me about what you've heard from drivers who have now signed up to work with you guys and what that looks like as you work kind of in a similar, I guess, taxi model.
Yeah, I think one thing first, our goal here is broad electrification. And one thing that we're already seeing, even with just one fast charging super hub in the ground, we have drivers coming up to us from other rideshare services that made the decision to go electric because a super hub finally exists and they feel confident they have access to charging. But when it comes to just demand for drivers for our new service, we've had well over 1,000 applications from existing drivers looking to make the switch to our service. So drivers that are looking for a guaranteed hourly wage, access to paid time off, access to healthcare, looking to drive an EV, and honestly looking to make a living without having to shoulder the burden of vehicle expenses. Because we own and operate the fleet, we cover all expenses. So drivers are able to make a living without having to burden that cost.
It's an interesting shift away from that. And as you said, a lot of the times, first-time riders are riding in a Tesla, maybe the first time drivers are driving one as well. But Paul Suhey, Revel Co-Founder, appreciate you coming back on here to chat with us today.
Meal kit company Blue Apron saw its business boom during the height of the pandemic as more people cooked at home during quarantine, but holding on to that momentum is proving to be a challenge. Blue Apron swung to a loss of more than $18 million in the second quarter, while revenue fell from a year ago. Joining us now is Blue Apron CEO Linda Findley Kozlowski. Linda, it's good to see you again. You know, if you look behind these headline numbers, there are a lot of positives in this report, including growth in some key metrics like average revenue per customer, but you did lose 21,000 customers in the last quarter. Why wasn't Blue Apron able to hold on to those customers and build on that number?
It's important to think about how we actually define customers and how we look at seasonality in the business. So the reality is what we saw in Q2 was actually very expected and in line with our guidance. So first of all, Q2 of last year was the peak of pandemic demand, and that's when everyone saw sort of their biggest surge in pandemic demand. So we intentionally looked back to 2019 to think about how we could actually do a real comparison of the business. And of course, we grew over the period in 2019 if you're taking out that pandemic piece. As far as the move from Q1 to Q2, there's a lot of seasonality in the meal kit business. So Q1 is always the biggest quarter in the meal kit business, and you see this consistently across the industry. Where you get into the second quarter, and you usually see a little bit of drop off as people travel, et cetera. And so people aren't as active during the second quarter and third quarter as they're traveling during the summer. So what we did see, however, is actually elevated demand over prior, to the pandemic, prior periods. So we see what's actually coming to fruition is exactly what we expected, which is return to seasonality, except for the fact that we're seeing much elevated demand from pre-pandemic numbers. We're seeing some of that pandemic behavior sustained, particularly in those key customer metrics, highest average order value that we've had, and continued strength in revenue per customer, with revenue per customer hitting $330 per customer.
Linda, I want to ask you about inflation. We have seen inflation in the grocery sector. We've seen shortages in supply chains, especially when it comes to transport. I'm curious to know how that's impacting Blue Apron's bottom line right now and the prices of the boxes that you can deliver to those customers.
Yeah, so I think one of the advantages that we have is really looking at how we manage our direct supply chain. So when you think about the two main aspects of our business, you talk about the food costs and you also talk about the logistics costs. And as we said this morning in our earnings call, we are seeing pressure, particularly on the logistics costs, which we're continuing to manage through with our logistics providers, making sure that we're being as efficient as possible in how we actually manage those logistics with our customers, trying to maintain a strong experience. But logistics is one of the areas where we're seeing some challenges that we're mitigating, both through our work with managing those logistics providers directly and creating more efficiencies in the business to help manage that. Food costs, we haven't seen as much inflationary pressures on our ingredients in particular because of our direct supply chain. We've been able to manage and keep the same high quality that our customers are used to. And we have seen some inflation there, but not as much of an impact on our business. However, we are actually constantly looking at how we can continue to test and manage into ways to both mitigate those costs, but also continue to create value to the customer at the right price point.
So Linda, you have not yet had to pass those higher costs on to the customer. What has happened in terms of pricing with the boxes?
So right now, the pricing of the boxes is the same, but it is something that we continue to test and make sure that we're having the right mix of food costs and logistics costs into our customers' business as we work through the efficiencies on our side. So we're keeping that value as high as possible, but at this point, we're still at the same price we were before.
Of course, I know you're always going through innovations with your menu. You added a few things over the past quarter, including these add-ons where you can add an appetizer or a dessert to your box for extra. You have something called Butcher Bundles. I'm curious what's in store this quarter and next, and what are some of the trends you're seeing among consumers right now? What are they really into?
Yeah, this has really been our strength, and we continue to see a lot of rewards out of our product innovation. As we've introduced new premium products, new price points, new options for people, we're seeing, again, that increased AOV, increased revenue per customer, and that's all been incredibly strong. And that's really where we're starting to see also increased retention of our customers as we engage them with these new products. And this has been our strategy all along, really focus on long-term growth that gets us to that adjusted EBITDA profitability target next year. So that's been a very important lever for us. The trends we're seeing are very interesting. So the premium products continue to perform well and are doing quite well. Particularly, we just launched a craft burger, which is an extension of our premium line. In the 2 weeks that it was actually available in Q2, the sales were strong enough to actually contribute 2% of our overall AOV increase for the full quarter, even though it was only available for 2 weeks. So burgers, of course, summer, it's really popular right now. The other thing is we're seeing a lot of return to health. And so we're seeing a lot of people pick up on some of our healthier options, our Wellness 360 options, which represent our highest value customers, very engaged customers, a lot of fish, a lot of seafood, a lot of lighter eating coming into the summer. And those are really two of the biggest trends that we're seeing right now in consumer appetite, to be direct.
I want to ask about geography in the United States, especially as we see the pandemic impacting this country a little bit differently as we see these surges around the country. I'm curious to know if there are geographical weaknesses or strengths right now to Blue Apron.
So in general, our customer base has always been pretty evenly spread across the country. And so we don't necessarily see differences in our normal core demographic. We tend to be attractive to urban audiences, also attractive to rural audiences because of the uniqueness and the quality of the ingredients and the recipes in our box. What we have been able to do is watch very carefully, both during the pandemic, as things started to open, and of course now as we're starting to see increases in the Delta variant, we are actually able to track by geography how the business is doing. And very clearly we saw, as things were opening back up again, we saw a little bit of travel behavior, but what we saw were those key customer metrics staying high. So people are continuing to order a lot of recipes from us and continuing to add on, do customizations, do the premium recipes. And so that behavior is very promising for long-term for the business. And we're really excited about that engagement. It didn't really waver with the reopening at all with travel. It's still very early as the country kind of grapples with the Delta variant. We're very prepared to make sure that we can meet any demand that actually comes to us. But what we're focused on most is making sure that we can keep our employees safe and safely deliver to people as they're figuring out their new sort of way of life as mask mandates open up again. But geographically, we're fairly strong again across all parts of the country and haven't necessarily seen any significant drops or deficiencies in any one region.
And Linda, real quickly, in 20 seconds or less, do you see the company being able to reverse that quarterly loss this quarter? And what's the outlook for the rest of the year?
Well, again, if you look at our cash position, we've done a lot of work to sort of grow and focus on that. We said very clearly that what we saw in Q1 was an anomaly, and we've made up for that a little bit in Q2. All of this was not only within expectations, but in many cases better than expectations. And we continue to focus on managing that going forward because we are targeting and have guided to getting to adjusted EBITDA profitability next year. And we're just working through those fluctuations in seasonality.
All right, Linda Findley Kozlowski, Blue Apron CEO. Always good to see you. Thanks for stopping by.
A new and yet to be released report from Edelman shows the lack of trust between financial service providers and communities of color. We have Lisa Osborne-Ross, CEO of Edelman United States, here to give us an advanced look of the findings. So, Lisa, I'm hoping that you could do a little bit of scene setting here for us. How is the relationship, or how would you define the relationship right now between communities of color and that of financial service providers?
Because I'm an optimist, I will say it could be better. There are systemic issues that communities of color have dealt with historically with the financial sector. Our research indicates that a lot of the things that we have seen historically, biased treatment, unwelcome environments, excessive scrutiny, et cetera, continue. However, there are some bright spots, and the opportunity to fix things is a lot better.
I want to dig into this report before we talk about how to fix things, just to highlight some of the findings here. You say that communities of color reported systemic bias regardless of their personal financial situation, meaning that even if somebody was a high income earner, sometimes their experience was even more negative. Can you talk to us about that?
Yeah, it was for me one of the most intriguing findings. And the key findings, again, were one, bias exists. Black Americans, API, Latinx across the board said that they experienced bias in all sectors. The bias was with mortgage lendings, with bank, auto, credit card, insurance, et cetera. Second key finding is the one that you just talked about, that regardless of income, that the level of bias and the level of discrimination continues, and in some cases is even higher. I think this one is particularly interesting because the last time I was on your show, we had released our data that talked about is racism people or is it institutions? And people, the respondent said, it's really more people. And I think this research indicates that that's not actually true. We always talk about the difference. People say, Lisa, is it class or is it race? No, it's race. Because we have people in higher income brackets, people who make over $100,000 and people who make $1 million a year, and they face some of the same systemic bias that people at lower income levels do. So it kind of doesn't matter whether you make money or not. You're still seen as a person of color, and then a series of assumptions are made about you regardless.
So what's the impact of that racism? As you mentioned, it's not class, it's race. What ends up being the ultimate result of that racism?
It's sickening, actually, and it's discouraging. But again, I'm an optimist, and so I think it can be better. The impact is, one, we're not putting to work all the resources that we could have. Communities of color make money. We are entrepreneurial. There is a history of that. We're celebrating the 100th anniversary of the Tulsa race riots. The first woman millionaire was a Black woman, Madam C.J. Walker. And so what you're doing is you are eliminating and discouraging people from putting their money into the system, because absent fair treatment, people use payday lending. They're using pawn shops. They put money in their own homes. And the other impact, and this was acute among the Latinx community, is the impact on mental health. People across the board in all of those categories, Latinx, API, African-American, talked about the impact is palpable. It doesn't make them feel good. It makes them insecure. And the Latinx communities, 59% said, I'm uncomfortable even talking about money. That's never good. Another 52% said, not only am I uncomfortable talking about money, but it affects my mental health. It makes me sick when I think about it. I think about how I'm being treated, how I'm being discriminated against, and the lack of opportunity that is available to me because of this bias. So it hurts our systems, it hurts our institutions, and it hurts people.
So in the time we have remaining, just talk to us about some key things businesses on the financial services end can start doing today to start moving the needle here.
I'm not going to say they're easy, but I will certainly say they're doable. One, build representation into your workforce. Two, consider bias mitigation training. Some bias is real, but some bias I will accept that people really don't know that they're doing it. So look at how you can train people to detect bias and to prevent bias and to make sure that there's repercussions when there is bias. Three, reevaluate risk assessments. One of the first questions you asked is that, is it worse among communities of color who are higher income? Absolutely. So look at the types of questions that you're asking. How are you assessing risk and how are you assessing engagement? And look and see if there is bias there. And then the last one, create inclusive, welcoming environments. The volume of communities of color who say when they interact with the financial institutions, they talked about banks in particular, things like not being greeted when you walk in the door, being treated differently. When you have a welcoming environment, people feel better about giving you their money and working with you to grow their money, which is good for them and good for us as a nation.
All right, we're going to have to leave that there. Lisa Osborne-Ross, U.S. Edelman CEO, thanks so much for joining us today. Welcome back. Teletherapy has soared, especially throughout the pandemic, as more people are focused on their mental health and they need for virtual visits. It's a surge that has propelled the online therapy platform Sondermind to unicorn status. We're joined now by Mark Frank, Sondermind CEO, as well as our health reporter, Anjali Kemlani. So Mark, let's just start here with the model that Sondermind has. It is a hybrid model, so you can see your therapist online, but also in the office. So that's a little bit different from what we see from some of these other platforms like BetterHelp or Talkspace. Why this hybrid model? And do you think folks are going to be more interested in that, especially as we leave the pandemic behind?
Absolutely. So Sondermind is really focused on providing the best care that will improve people's mental health better than anyone. And so we use technology to really ensure, first, that we create a really seamless experience for all of our therapists, as well as the consumers and individuals who are seeking care. And then, as you mentioned, we really employ a hybrid model. So it's not about whether you're using video telehealth or in-person care. It's really about getting you to the right therapist and ensuring that you can continue seeing that therapist in the means and with the mode that really makes the highest impact for your clinical needs.
Hey, this is Anjali. Thanks so much for joining us. I want to know, looking at sort of the trajectory that you have, you're now operating in 10 states, want to go nationwide by 2023. What are the next maybe 5 states that you have lined up?
So right now, our footprint is pretty diverse. We're based in Colorado. We spread across to Texas and Virginia and Ohio, Missouri, and Georgia, as well as a number of other states. We are looking at expansion across some other states on the eastern coast, so likely around North Carolina and potentially Massachusetts and New England, as well as some more states in the Midwest, so areas that are somewhat geographically proximate to Missouri and to Kansas and Colorado, where we have a really good footprint right now. At this point, we actually cover 73 million American lives who have commercial insurance or have Medicare or Medicare Advantage. So we have a pretty good footprint already, and we're certainly going to use this new capital to propel us to a national footprint.
Yeah, I want to talk more about that new capital, Mark. You're in a really enviable position, raising $150 million in a funding round co-led by Drive Capital, vaulting the company to that unicorn status. You have a valuation of more than $1 billion now. Talk to us about what this money will help Sondermind do, and what other markets do you hope to expand into in the near term?
Well, like I mentioned, we are absolutely going to be expanding across, at the end of the day, over the next 2 to 3 years, to have a footprint across the entire country. And another big use of capital for us is to continue expanding on our technology suite. We use a pretty comprehensive full stack solution that gives us a lot of data. And what we do with that data is we first let it inform getting you the right therapist. So we have a good understanding of which therapists provide the best clinical care based on specific needs and demographics and things like that, which is really, we see as pretty unique amongst the industry and the competitive set. So we're going to continue to reinvest capital into our technology solution, into our data and learning models, so that we can just continue to focus on providing, at the end of the day, the best clinical outcomes for every person who's in need of care.
Mark, looking out into the future, I know that you've been pretty conservative about the growth, but looking at where you are right now and the status you've achieved, do you have any idea of when you might exit, go public, et cetera, what the future holds for Sondermind?
Yeah, that's a great question. Our real goal at the end of the day is to make sure that we can achieve our mission. And so whether that's as a private company or as a public company, we do believe that we're going to remain an independent company for the life of the organization. And so, I would say it's too early to tell whether we'll be looking at an IPO or another way to go public. But at this point, we're really excited about the capital partners we have behind us.
All right, we're going to leave that there. Mark Frank, CEO of Sondermind, health reporter Anjali Kemlani, thank you both so much for joining us for this conversation today.